For most of the last decade, two publicly traded companies classified prison cells as income-producing real estate, occupancy clauses functioning like anchor tenants, guaranteed by the state. Investors could gain exposure through a tax structure designed for apartment complexes and shopping malls. The economics of private incarceration aren't hidden. They're in quarterly filings. And the money trail begins with a single number inside a government contract. The state of Tennessee pays $134,937 every day for a single facility in Trousdale County. This transaction operates on a contractual rate of $58.75 per inmate per day, a unit of exchange known in the industry as a per diem. However, public disbursements do not fluctuate based on the actual number of people held inside. The agreement contains a 90% minimum occupancy guarantee. If the facility holds fewer inmates than this threshold, the state must pay for the empty beds regardless. This single clause secures an annual revenue floor of over $44 million. In this market, the physical structure of the prison is secondary. The primary financial asset is the contract itself, guaranteed by a government signature. Building a modern correctional facility requires massive upfront capital. In Utah, a state-owned prison completed in 2022 cost $592 million to construct, plus $100 million for the land, amounting to roughly $125,000 for each of its 3,600 beds. In Alabama, the Elmore County project is projected to cost $1,080 million for 4,000 beds. Yet, the physical structure is not the real barrier to entry. In this market, the state is effectively the only buyer. Because there are no commercial customers, a facility is non-functional without a government signature. The true asset is that signature, securing a rate structure that can rise over time. In Arizona, private per diem rates moved from $61.50 in 2005 to $69.57 today. Access to these escalators is highly concentrated. Two dominant public operators, CoreCivic and the GEO Group, together held roughly 8% of all state and federal prisoners, generating a combined $4.8 billion in revenue in 2025. A Government Accountability Office study of 36 medium security prisons provides a baseline for what it actually costs to run these facilities day to day. The study found that operating costs range from $22 to $88 per inmate per day. The data shows that salaries and staff-to-inmate ratios are the primary drivers of these expenditures. More recently, the Federal Bureau of Prisons reported a benchmark of $93 per inmate per day for privately operated facilities in fiscal year 2022. For private operators, profitability relies on a basic mathematical formula. The operating margin is simply the daily per diem rate paid by the state, minus the daily cost of housing each person. Because the government buyer sets the per diem rate, operators control the spending side of the ledger. This relationship explains why legal analyses, such as those published in the Arizona State Law Journal, suggest that contract design, rather than privatization itself, drives these institutional incentives. When a contract is built on a fixed per inmate per day payment model, it structurally rewards the operator for minimizing daily operational expenses, transforming staff wages and facility services into direct subtractions from profit. Minimum occupancy clauses systematically convert empty beds into guaranteed public payments. At Florida's Bay Correctional Facility, a 90% occupancy guarantee translates to a minimum billing baseline of 887 inmates, securing $43,046.11 every single day from the state. In Arizona, agreements for Florence West, Phoenix West, and Marana operate with 100% occupancy guarantees, completely eliminating the financial risk of vacancy and ensuring full contractual payout regardless of actual prisoner counts. For private operators, these contractual mechanisms yield highly predictable, recurring revenue. In fiscal year 2024, CoreCivic reported an average revenue of $102.79 per compensated man day, representing roughly $37,500 annually per inmate. This steady structural foundation supported a reported net income of $116.5 million in 2025, representing a 70% increase over the previous year. During the same fiscal period, the GEO Group reported a net income of $254 million, an increase of approximately 700%, with expanding federal immigration detention contracts serving as the primary driver. Federal agencies function as a separate, highly capitalized buyer stream that operates alongside state-level agreements. In 2018, the United States Marshals Service disbursed approximately $1 billion to local and private detention facilities, while immigration and customs enforcement spending reached roughly $340 million. Operating margins within these federal contracts are further supported by low service costs, including a policy that permits the reimbursement of detainee labor at a baseline rate of just $1 per day per worker. This combination of guaranteed state occupancy and stable federal demand creates a predictable, recurring cash flow system that operates independently of traditional real estate market fluctuations. The flow of capital inside these facilities extends beyond government per diems into auxiliary services. Telecom providers secure exclusive contracts by paying commissions back to the facility. These payments, which historically averaged 42% of gross revenue, created incentives to favor the most expensive provider. To address this pricing distortion, the Martha Wright Reed Act was signed in January 2023. Under FCC caps effective in April 2026, prison calls are limited to 9 cents per minute. Large jail calls are capped at 8 cents, while small jail calls are set at 17 cents, plus up to 2 cents for facility costs. This phone revenue functions as a secondary stream within the larger prison economic system. In the early 2010s, the financial architecture of the industry shifted from simple service provision to real estate investment. Both CoreCivic and the GEO Group converted into real estate investment trusts, or REITs. Under this tax structure, a corporation avoids federal income taxes if it derives its income primarily from real estate and distributes 90% of its taxable earnings to shareholders. The financial impact was immediate. In 2017, the GEO Group recorded a $43.6 million tax benefit from its REIT status. This model made owning physical assets far more lucrative than simply managing them. CoreCivic, for example, drew roughly 90% of its revenue from 43 owned facilities compared to just 7 facilities it managed without owning. The company also held a 3.3 million square foot commercial property portfolio. Under this framework, a cell block became a rentable unit, and the 90% occupancy clause functioned like an anchor tenant. But the mandate to distribute 90% of profits eventually limited operational flexibility. In 2020, CoreCivic compared its $210 million dividend payout to a projected $196 million corporate tax burden, electing to revert to a C corporation in January 2021. The GEO Group followed in January 2022, trading the REIT tax shield to retain cash for debt reduction. Both CoreCivic and the GEO Group are publicly traded corporations. Their largest institutional shareholders are Vanguard, BlackRock, and State Street. These asset management firms do not necessarily select these stocks based on active corporate strategies. Instead, they purchase them automatically to replicate broad market indices. These shares sit within passive index funds and mutual funds held by millions of ordinary retirement accounts. Most individual investors holding these assets never made a conscious decision to buy them. Through standard retirement plans, a portion of personal capital is frequently allocated to the private prison industry without the holder's knowledge. Today, the underlying asset is not the facility itself, but the government signature on the contract. As passive index funds distribute these holdings, public exposure remains systemic, quiet, and largely unrecognized. The market simply functions as designed. Join the conversation in the comments below.